with these meme stocks, right? I mean, we talked about it last week, Carl. The fact that they're seeing so much retail attraction. I've got some stats for you. So AMC stock, which, we don't own any of these, but we have to talk.
Thankfully.
Yeah, thankfully. 580 million shares of AMC stock traded today. Yesterday, or on, I would say Wednesday, the AMC shares, when they rose about 95%, they had the more volume than Amazon has ever had in its entire history as a company. And it didn't even crack the top 10 of highest trading volume, which all of those are held by Tesla, ironically. But another interesting point about Amazon is or about AMC is the massive amount of explosion. I think it was down like 30% this morning, went back up into positive territory, and I think finished down, 15 or 16%. So, walk me through, using your brilliant brain, what you see going on here, because it is catching the eye of a lot of retail investors, that's for sure.
Right. Well, I mean, when the retail investors get excited and they're out in force, there can be a lot of craziness and a lot of trading. I mean, it's sort of like the 13 or 17-year cicadas. You just get totally overwhelmed with, and we're in a kind of a speculative environment. I mean, we saw this happening last year, and then this year, early, like in January, around GameStop and some of the other so-called meme stocks. But it's happening again, and there's some reasons. But first, maybe what we should do is talk about what meme stocks are. So memes are like themes in culture, and that people watch and follow. And a meme stock is one that goes viral in an online chat app or forum like Reddit. It attracts a storm of buying from retail investors with a lot of enthusiasm, especially if the stock is highly shorted by hedge funds and other elite investors. And so this plays into the wealth polarization that's out there. So a lot of people like to use trading apps like Robinhood to place trades. And if they collectively buy enough of a heavily shorted stock, they can create a short squeeze and punish elite investors.
Yeah, and to that point, the retail flow. So there's a company that tracks retail flow. And according to retail flow, $154 million flowed in from retail investors yesterday into AMC. So, I mean, they do have power, right? And obviously the short interest, I think, was in the 20s for AMC versus GameStop, which I think peaked at like 200% or some ridiculous number. So not quite as much short interest, but there's enough there. And what that does is it causes these wild swings like what we've seen, right?
Yeah, I mean, I'd be curious to dive into where people actually track all of those numbers, because I think it's a little bit difficult. That there's so much going on, and sometimes it's hard to really discern, the difference between like retail and institutional, and where all the flows are coming from when everything gets really chaotic. And then there's brokers who may be restricting trading, and then you're wondering, like, okay, well, if trading is continuing to go on, like, where is it coming from? But it really just this week it happened because AMC is one of the heavily shorted companies out there in this group. It's a movie theater chain that hasn't been doing so well. Things are getting better for them, but they're still losing money.
I just can't wrap my head around it. Okay, so at the close of Wednesday, it was valued higher than over 50% of S&P 500 companies. This is valued at roughly $35 or $36 billion. Nobody's going to the movies. So what are they going to do to reinvent themselves? People have gotten used to online streaming. And I've said this before, even on my personal podcast, when I brought up GameStop, is I don't have a problem with people making money. But it does seem to me that investing has really morphed into gambling over the last, let's say, 8 months or 9 months? Is some of that due to the massive amount of stimulus that's been pumped in? People sitting at home. You and I, read an article in Fortune by Josh Brown today, which almost perfectly painted the millennial to boomer generation of investing. And it's scary to think maybe that's what at least the short-term future holds. And at the end of the day, it's the person that sells last that's left holding the bag, that may never want to get back in the market again and invest.
Right. Well, it just speaks to the speculative environment that we've had, really, because for the reasons we've mentioned before, that you've had a lot of stimulus. You've had people at home looking for, working from home and looking for an outlet to satisfy any gambling addictions or maybe some recreation.
Right.
Not everything is opened up yet. Not everyone is back working in the office. So there's looks to be a good amount of that. And the other thing is that once someone makes money trading any of these crazy things, I mean, they might feel really empowered to keep doing so until they lose so much money that they can't do that any longer. So
like chasing a high.
right, we're seeing some of that too. Like once the gambling addiction gets rewarded a little bit, then I mean, if somebody makes $50,000 or $100,000 or more trading these things, and especially if they're not working, I mean, they're doing that with maybe a little bit of savings and some stimulus checks, maybe they feel godly, and it's really hard to change that psychology until they've they suffer a loss that's even worse.
Well, I can tell you one thing that they won't be doing is selling and putting it into T-bills, right? So that's
way too boring.
Way too boring. So before we wrap up this segment, I just wanted to point out, we hear all the time, at least in this industry, well, why don't I just stick it in an ETF, right? Why don't I just stick my money in an ETF? Well, one thing that you and I discussed earlier today was, through research, you really don't even know what some of these ETFs own. And if you're just blindly buying a value ETF or an index ETF, sometimes you don't know what those are, or maybe you're getting exposure to specific ETFs because of the allocation that you've chosen, and you don't know what's inside of those. So I ran a quick list, and I know some of the Russell 2000 value index ETFs have smaller exposures, 1 or 2 or 3%. But there's something interesting, the Invesco Dynamic Leisure and Entertainment ETF. That has a 20% exposure in AMC stock. Now, granted, maybe it was only a 7% or a 5%, and they haven't trimmed it, or whatever the reason is. But if you own that, you've now got a 20% exposure in AMC stock, which warrants some potential for downside exposure. Higher than that is the Sofi Social 50 ETF, and Sofi is the company that's become popular with millennials, easy digital banking, easy digital investing, and then they rolled out an ETF platform. Sofi Social 50 ETF has a 27% position in AMC alone. So just know what you own, people, right?
Right. I mean, those are nichier ETFs, but we were even looking at the iShares Russell 2000 value. A lot of people think of value investing as being relatively safe. Right. I mean, you're not, safer because you're buying companies at lower prices. They can't go down as much. But when you look at that one and you see how much everything, so these companies like AMC and GameStop, they used to be value kind of companies because they weren't doing well and they traded at low prices. But then when they caught this wave of retail euphoria going on, now they're the largest positions in this ETF.
Oh, how's it going to end? Tell me how it ends.
Well, we don't really know when, but generally these things don't go on forever. The history of markets is that things can be emotional and crazy over a short period of time, and sometimes that can even stretch out to years. But generally, ultimately, stocks have to trade based on where their earnings are and where the growth and the fundamentals of the companies that issued them are. and you can't really get away from that. Eventually it things go in that direction.
Yeah, just wear your life jacket, everybody, just in case. We don't know when, but there will be a day. And the one caveat that I would put in there is this big influx of millennial investors and younger investors, and the accessibility of apps and being able to buy on margin. Maybe that generation just has a different risk appetite that will, push these names, even further. I don't know.
Right. Well, it's also confounded by a lot of these people not having a lot of experience in financial markets either. Like if your first experiences were making a huge amount of money in any of these kinds of stocks, and you didn't really know why you bought it, you just maybe read about it on a chat forum and it sounded good, you might think that this is really easy, like I can just make tons of easy money, but that's not the way it is. There's a whole industry around, managing strategies and funds, and there are reasons those kinds of people who really think about what companies are worth and what the financial statements look like and have a long career experience doing that. They don't just go in and buy something because it's doing well or a bunch of other people are buying it. Those aren't very good reasons. And sometimes those kinds of situations can creep into the professional world too. And often those have led to some of the biggest mistakes that a lot of firms have made.
Right. Now, what I would love to see Reddit or Wall Street Bets do is start the 5-year thread. Everyone likes to post, how much they're up, in the last 6 months or the last year, or even in the last few days. But I would love to see a Wall Street Bets 5-year thread. Where are we 5 years from now? Right. That would just be something interesting. But
yeah, and also maybe change the tone of YOLO, you only live once, to you only live once, so you better do it right the first time.
I love that. That's brilliant. Can we coin that? Can we trademark that, anybody?
I'll license it to you.
Okay. All right. Sounds good. All right. So another big thing that came out this week, it affects all of our clients, anybody that makes any kind of money or distributes money from their portfolios or invest in assets that see appreciation, and that is taxes. So Joe Biden released his proposal this week. It was in the budget that was at least proposed, and nothing's official yet. But Carl, walk us through kind of what this is looking like and why these things make our job even more complicated.
Well, it's complicated because there's probably going to be a big increase in taxes, capital gains rate. Right. So we'll just have to think about how we're going to respond to that. It may not make sense. It probably doesn't make sense until there's some clarity around like what is actually going to happen. Right now, it's a proposal, and it's really all about financing the Biden administration's legislative agenda.
Sure.
So his 2022 budget calls for an increase in the top capital gains tax rate to 39.6%, like ordinary income. And so top earners could pay as much as 43.4% if they're also subject to the 3.8% Obamacare surtax. So that would affect single individuals earning $452,000 or more, and married couples over $509,000. So that's pretty high. So that won't affect that many people, but for the people it does affect, it'll be significant because they're used to long-term gains rates around 20% right now.
The top end, so, 0 for the first 80, 15 for the next 80 to 420 something, and then above 420, it's 20% plus the 3.8. So a lot of people are really used to 15. So going from 15 to potentially the top rate of 39.6, which is at the ordinary income level, is going to be a pretty significant change. And the caveat in all this is that they've seemed to make these, if it goes through the way it is, is they've made them retroactive to April and then May for ordinary income.
Right. It's not totally clear what date yet, will be the one. But that's the thing about tax law changes. They're often retroactive, but the good thing is that they're usually only retroactive to sometime in your current year or
Right.
or January 1st.
Yeah, and I was thinking about this the other day, and I thought maybe this would not make people want to sell.
Probably not. If the
And
tax law changes retroactive and they don't have any time really to react to it, then it's not going to necessarily change a lot of people's behavior. Now, if it got slowed up and it happened slowly near the end of the year, then it's possible or likely that there could be, if it looked like it wasn't going to be made retroactive and maybe could take effect next year, then we could see a wave of selling and gain harvesting going into the end of the year. And you see that anyway every year, particularly years when equity market is up a lot. You see a lot of gain harvesting and loss harvesting too in the fourth quarter.
Yeah, it's definitely interesting. I just thought of it from the standpoint because everyone said, oh, well, when they raise this, everyone's gonna, big massive selling, but not necessarily unless they need the assets. But that's why it's so important. Like when we do planning for, people that are in definitely their 20s, but even their 30s and 40s, where they've got potentially 20 more years of accumulation, we've really shifted over the last, 4 years of, at least giving them the recommendation of contributing to the Roth portion of their 401ks if it's available, because then you have total control over the destiny of distributions in retirement, and you're not really handcuffed by what the current tax law is. And that can be really big. Pay the taxes on the money today when tax rates are the lowest, defer the growth and take it out tax-free. Not saying that can't be changed at some point. But it's just a concept of just planning correctly, especially when taxes are almost at an all-time low, and at least in this country.
Right. You can't predict the future, but
we try
to have your best view and have the right balanced strategy and approach so that you have different levers to pull in any scenario.
Right. Well, hey, I think we crushed it. So we covered meme stocks, we covered the Biden tax proposal, what's coming up. So we'll see everybody next week. Thanks for listening.
Thanks. See you next week.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.